We will begin. Hello, everyone. My name is Aaron Dubnikov, and I'm Managing Director of Sales for Arrow Capital Management, covering advisor teams in Manitoba and Saskatchewan. Welcome to today's call featuring Ted Whitehead discussing the Exemplar Growth and Income Fund. Joining us today are a number of my colleagues from the Arrow Capital offices across the country, as well as advisors and associates from coast to coast. A special hello and thank you to Colin in our Toronto office for assistance with the deck and setting up the Zoom call today. And I'd also like to give a special shout out to all of the advisors in Manitoba and Saskatchewan who have joined today's call. It's been a pleasure seeing some of you recently, and I'm looking forward to catching up with the rest of you now that it's a little bit easier to conduct in-person meetings on the prairies. I think the timing of our call today is very good, considering all of the headlines: COVID recovery, China lockdown, rising rates, inflation, war in Ukraine, and I had market volatility, which is especially important on a day like today. You can pick your narrative. They're all very interesting topics. So it should be helpful for all of us to hear some thoughts from a manager who has historically been able to do an outstanding job to reduce volatility while providing exceptional returns for our unit holders. Anecdotally, I've been receiving a lot more inquiries from advisor teams asking about strategies that can help reduce volatility. More and more people are recognizing that volatility reduction is an effective strategy for keeping clients invested and on track to meet their investment objectives. I'm hoping that today's presentation will help you understand how Arrow Capital is very well positioned to help you and your clients navigate through what is likely to continue to be a very challenging year. Before I pass the meeting over to Ted Whitehead, I just wanted to quickly run through a couple of slides. You may have noticed on the first slide, the deck font was a little bit different. This corresponds with new updates that we've made to our website. So if you haven't had a chance to take a look at our new website, I would encourage you to do so when you have a moment. If we can advance to slide 4. On slide 4, I wanted to share with you the lineup of Arrow's mutual funds and liquid alternatives, pointing out strong performance. And that in January of 2022, this year, we launched the Exemplar Growth and Income Fund, which is the third fund listed in the mutual fund grouping. It is managed with the same process as the Growth and Income Fund that we'll talk about today, but as the name implies, is global and fits in the global balanced category. So if you've been enjoying the returns that you've been getting from Ted and his team on the Growth and Income Fund, and perhaps are a little disenchanted with a global balanced mandate that you currently are using, please reach out to one of your local Arrow representatives, and we would be very pleased to provide you with details on the new fund. And the final point on this slide, for the IROC advisors on the call, it is likely that you have already taken a look at the liquid alternative strategies that we have available, but it certainly doesn't hurt for us to remind you of the performance that we're showing. But for the MFDA advisors on the call, it's important to note that some dealers are beginning to allow liquid alternative solutions on their product shelves. It's an area of the market that is likely to continue to grow, and we wanted to remind you that Arrow has been managing hedge and liquid alternative strategies for over 20 years. This business is not new to us. And before I introduce Ted, just a reminder that we will have time for Q&A after the presentation. You can send in your question by clicking on the Q&A button on the bottom of your screen, and we'll be happy to ask those questions that we've received at the end of the presentation. Ted Whitehead is a senior portfolio manager at Arrow Capital Management. Ted has been in the industry for over 30 years, and prior to joining Arrow, spent 20 years with Manulife Asset Management. He has also held positions with Credit Suisse and RBC Dominion Securities. Without any further delay, I'll turn the meeting over to Ted.
Okay, thanks a lot, Aaron. Yeah, it's a good day to talk about the markets. If you want to flip the slide, Colin. There's our disclaimer. You can read that on your own time. So we're going to cover the overview, which is our process, what happened in Q1 and what to expect in Q2. And throughout the presentation, we kind of talked to what to expect throughout the year. So we have this little cartoon from Hedgeye, which we focus on the data and other people cry to their mama. Anyways, on to the next slide. We took this quote from Annie Duke, who was a poker player. Improving decision quality is about increasing our chances of good outcomes, not guaranteeing them. So the idea is nothing in life is for sure except death and taxes. And when it comes to investing, everything is about understanding what the probabilities are and what are the risks to making a decision. And some decisions work out and some decisions don't. But it's making it so the odds are in your favor. Next slide. So we're more or less a macro fund where we're trying to understand where we are in the economic cycle. And we break it down into 4 quads. Quad one is when you're coming out of a recession or slowdown. What tends to happen, there's slack in the system. So there's growth without inflation, and PEs are able to expand. In the second quad, it's later in the cycles. So there's growth plus inflation. And this is usually when the Fed begins to hike rates. And in quad 3, the Fed hikes start to take effect and slow down growth. But inflation is always a bit of a lag. So this is where you experience PE contraction. And lastly is finally inflation starts to come off the boil, and you have both GDP growth and inflation decelerating, and that's when the Fed eases. So in our mind, why we think the Fed is making a policy mistake here and now is that we're in a quad 4 environment where we feel in CPI or inflation rates are on the cusp of rolling over. I know we've been saying that since the first quarter, but it looks more and more like that's going to happen. And GDP growth has already begun to slow down. And we saw the first quarter GDP growth was negative 1.5% in the US. So normally when the Fed would hike rates is quad 2, when you have inflation accelerating and growth accelerating. And we think that's not the case. Next slide. So we've broken it down into the 4 quads and what works in the different environments. And generally speaking, in quad 1 and 2, you want to have exposure to equities and credit and underweight fixed income. And in quads 3 and 4, the opposite. In quad 4, you want to be in more defensive sectors of the economy, such as utilities, consumer staples, healthcare, and REITs. And underweight financials, industrials, energy, and technology. Next slide. So this slide gives a little more detail and breaks it down into factor styles as well. For example, in the quad 4, you want to avoid high beta, momentum, leverage, secular growth, and cyclical growth, and focus on low beta, dividend yield quality, defensives, and value. Next slide. So to determine whether you're going from one quad to another quad, these are some of the trading signals that we use. One of the ones we write about every week is the VIX index. And when the VIX is sub 20, it's a good environment to be in equities. When it's 20 to 30, it tends to be choppy, more of a trading market. And when you're above 30, you tend to want to avoid equities. Now, having said that, there will be a point where the VIX may reach like 38 or 45, and that will be a buy opportunity. So it's also understanding whether you're in a trending regime where the VIX is trending up, like hitting higher highs and lower lows, or lower highs, sorry, and or whether it's what we call episodic, where the VIX will just spike up to say 30 or 31, and within 3 or 4 days come down. And that's usually what you would see in a bull market, where the VIX would go up to say the low 30s, the market would experience a 2 to 4% correction, and then the VIX would come back down to the teens and continue going up. Next slide. So what do we forecast in the first quarter? We were recommending quality and defensives would outperform, value over growth. We have experienced more volatility, a lower US dollar. One of the things we've been wrong on most of the year and continue to have, I guess, difficulty with is the yields. We thought they would be remain below 2, but that didn't happen, and we'll talk to that. We expected oil prices would go down, gold to go up, credit spreads up, financial conditions tighter, and the VIX to be in a range of 15 to 25. So more or less a trading type of market. Next slide. But what we got was a stagflation environment. It did start off as a quad 4 because the second day of the year, the market started heading down. But things changed through February, and one of the big changes was oil prices went up. They went up about $32 in the first quarter, and with that, that took up 10-year yields by about 82 basis points. We had a weaker US dollar, which was what we were calling for. We had a VIX spike to 38.9. and ended the quarter at 20.56. Financial conditions were tighter. Credit spreads blew out to 242, came into 187. Today, as I checked, they're around 208. And gold was higher in the first quarter by over $100. So we got some things right and some things wrong. And on the next slide, we can talk about what sort of made the market go one way or the other. Well, we can talk about the sectors first that did well. It was really very narrow as to what stocks performed, predominantly energy, and some of the defensives, utilities, staples did okay. Healthcare and the REITs, which would also be defensive, not so much, but we avoided discretionary and the technology space after about the first 2 weeks of the quarter. Next slide. So what changed in the first quarter was the Ukraine war, or the Russia invasion of Ukraine, which spiked commodities. Initially, what happened is bond yields had peaked at around 208 and then dropped to around 166 by March the 9th. But they started moving up and moved up much higher on the back of oil prices. I think initially the invasion was thought to be short-lived, and commodities were not really a big we're not going to be a big factor, but it turns out that the war continues to go on, and commodities produced in Ukraine and Russia are having a big impact on investments. In the Ukraine and Russia, they control or produce 20% of corn and 20% of the wheat in the world, and Russia produces around 8 million barrels of oil, and they supply Europe with about 40 to 50% of their natural gas. So in Europe, you can it's almost a certainty that they're going to experience a recession. Even in the UK today, they hiked rates and are talking that they expect a recession in 2023 in the UK. So that's one of the things that sort of derailed the inflation coming off the boil. Second has been the China policy, the zero tolerance, and the impact it's had on supply chains. And the third is with full employment, the Fed is now focused on fighting inflation and not growth. And lastly, there was a lot of volatility in the first quarter. Next slide. So here we showed this is the Bloomberg Commodity Index, and that you can see that spike right there. That was March the 8th. That was the peak in the Bloomberg Commodity Index. And since then, we've been making lower highs and higher lows. And it's either going to break one way or the other. We're still of the view that inflation comes down, and the view is because of growth subsiding. Next slide. Those are just a couple slides on China and the impact it's had on property transactions because everybody's been locked down. And here we make the statement lower PMIs for April are near certain or to be low. And they came out last night, and the PMI in China was 37 for the month of April, and it was 43 in the month of March. Those are represent contractions. So the economy in China is decelerating. And one of the reasons why oil did come off the boil and go down below 100 in the last 2 weeks was the demand for oil by China has come off dramatically. Next slide. As I mentioned, with the consumer, jobs are aplenty. There's 1.9 available jobs for every person looking for work. Unemployment's at 3.6%. The Fed has two mandates. One is stable prices, and the other is full employment. So we have full employment, so they have to focus on inflation, which, as we know, is running rampant at around 8%. So the Fed began raising rates in March 16th, 25 basis points, yesterday 50 basis points, and it appears that they're on track to do 50 in June and 50 in July. Next slide. Volatility, this was just to April 13th, and it's almost the second highest year so far. I suspect it's probably going to be as high as 2009, or at least very close. Just to give you an idea, on May the 3rd, which was Tuesday of this week, the S&P went up and down 1% 6 times during the day. That's a lot of volatility. Market couldn't make up its mind which way to go. And I think that's just something we're going to have to get used to, because a lot of the market these days is driven by CTAs, or computer trading algorithms, ETFs, not the pension funds and mutual funds are not the biggest players anymore. Next slide. So what do we see happening in the second quarter? Well, we're already about 5 weeks into it. So one of the things we'll point out is the fiscal gap, or so fiscal spending will be less this year than last year. Housing affordability is getting worse. Consumer sentiment is bad. Inflation is the Fed objective. Long-term bond yields, we're still optimistic and believe they can come down. Growth to slow, and we'll talk about the US dollar and gold. Next slide. So using HedgeEye's model for forecasting, you can see that the GDP from the first quarter of this year to the second quarter is going to drop from 415 to 312, which is a significant drop, just like it was from the fourth quarter to the first quarter, from 553 to 415. And so we have GDP slowing, and it's what we'd call a deep slowing. Anything over 1% would be considered deep. It does trail up or lift up in the third quarter and then go back down in the fourth quarter. I think we'll have to wait and see how things actually pan out at this point in time. But with the Fed on pace to continue to hike rates, that third quarter number could come down, and the fourth quarter could come down a lot more. Next slide. So on the CPI, again, in the fourth quarter, it was running around 6.7. Going into the first quarter, it was around 7.8, so fairly significant. And going into the second quarter, the number has been updated. It's going to come off by about 20 basis points to around 768 is the forecast, and then dropping dramatically in the third quarter and the fourth quarter. So that's why this quarter still felt a bit like stagflation, with oil prices in the $100 to $110 range. But to keep oil prices growing at the rate they did last year, you need to see oil prices average $144. And we don't think that's likely. So that input is going to start to be a drag on CPI on the go forward. Next slide. So there it just shows where things have been moving from over the last few quarters. And maybe while we have that up, from the third quarter of 2020 to the fourth quarter of last year, so 6 quarters, 5 of those quarters were quad twos, which is growth with inflation. So that was the prime time to be fully loaded in equities and pretty much most areas of the market. So now going into a quad 4, and if you are experiencing the volatility or the VIX above 30, you don't really want to be in too many sectors. And if you're going to pick some sectors, you want to be in the defensive sectors, such as staples, healthcare, REITs, and utilities. Next slide. So looking to where we are, we're in the quad 4 square. It's titled deflation, but really this is going to be a period of disinflation. And on the next slide, we'll show you that most cases of quad 4 are disinflation and not deflation. And so typically you want to be underweight, way underweight equities, overweight bonds. And again, that hasn't really panned out yet. We're thinking maybe tomorrow with the unemployment number, if it's more unemployed than people expect, that the bonds might start getting the bid that we are expecting. Next slide. So this is the outlook based on the quads for different economies. You can see Canada is in a quad 1, but it can easily slip into a quad 4. And I think that's what it's going to be doing in the back half of this this quarter, because in quad 3, it does go to a quad 4. And a lot of quad 1s can easily switch and become a quad 4, because quad 1, remember, is GDP accelerating with deflation going down, and you could end up with both going down at the same time. Next slide. So this is what I wanted to point out, is that deflation is fairly rare, but disinflation is more common, and that's what we're going to be experiencing this quarter. And it just means that the inflation rate is not going to be as high on a year-over-year basis as it was the quarter before. Next slide. So on the fiscal front, there's going to be less spending in this quarter, equivalent to about 6%, or $1.3 trillion. So on a year-over-year basis, that's money that's not coming into the economy as it did the year before. So that's going to act as a drag on growth. And you even heard it in Powell's speech. He talks about that there will be a fiscal drag going forward in 2022. Next slide. So what's happening in the housing is the demand is starting to wane. And if we flip to the next slide, it becomes pretty apparent as to why. Last year, mortgages were around 3.1%. Today, I just saw that the mortgages are 5.27. So if we use 5%, last year for $1,575 a month, you could get a mortgage for $369,000. At 5% this year, that same amount of money gets you $293. So about a 20% drop in affordability, which is fairly significant. So that is why I think you're seeing the demand for housing come off. And this is going to have to be the same in Canada as it is in the US. And in Canada, it's probably worse because housing is a bigger portion of GDP. And it may be on a bit of a delay, but ultimately, I think housing prices are going to suffer. And even in the month of April, what you saw in Vancouver and Toronto is transactions are down over 25% in the major markets. Next slide. So on the consumer front, according to the surveys, consumer confidence is back to where it was in 2008, and expected financial conditions are at new lows. So again, as much as people say the balance sheet is strong for consumers or their savings is high, the surveys don't represent that. It shows that the consumer is suffering, and part of that suffering is the fact that inflation has picked up, and the purchasing power has come down by consumers. Next slide. So how long is this going to last? Well, no one really knows, but we're already 23 months into it, which is about the average length. And as far as, you know, we started at 30 basis points back when oil was negative $37 or $36, whatever it got to. We're peaking here around 8%. And that rate of change is somewhat common to past periods of inflation. Now, the last column, when it says recession afterwards, there's only been one period where the answer was no. So I'd say you have to, going back to the Annie Duke quote at the beginning, you know, you got to put the odds in favor that we're going to experience a recession. And we had a negative quarter in the US in the first quarter, and a recession is defined as 2 negative. Maybe things get a lot worse than we think quickly, and we experience a recession soon. Next slide. So I thought I'd spend a little time on bonds, since that's been really our Achilles heel this year. So this is a logarithmic chart provided by Carter Worth from Worth Charting. You see him on CNBC on Fridays from time to time. And so everyone's always talked about the 40-year bond bull market. And you can see that it touched the line, and that line is actually at 283. And today we're at around 308 or 309. So we've blown through that line. But to change trend, you basically have to take out that other touch point on the line, which the number is 325.6. So let's say 325 or 326. And that would change the trend. And I'd say convincingly say that the bond bull is dead. I saw Scott Menard was on TV from Guggenheim and he proclaimed the bond bull is dead. But he did think there was one more rally in the bonds. So let's flip to the next slide. So this is another chart put out by Wolf Research. And again, it has poked through that, that line. But the point of this is really whenever it's touched that line before, you've had big corrections in the market. And so that's what we've been experiencing. This is a case of yields going up has caused the market sell-off. Normally, what gets yields to go down is the market is a market sell-off, but this has been sort of the reverse. So next slide. And this is a chart provided by Sid Nartari at CIBC. And in his opinion, the roof or the top between 3 and 3.3% will be difficult to get through. And one of the reasons is if you look at the monthly RSI, when it breaches 80 plus, it's usually time for a reversal. And it doesn't mean that we go back down to 30 or 40 basis points, but at least we can get some reprieve and yields can come back down. And again, if we're right and we start seeing a decline in or an increase in unemployment, you could get a rally in the long end of the bond market. So this is why we're staying committed to our bond position, which is about 34% of the portfolio today. Next slide. This shows the bond returns, and this is, I think, as of April 13th. I think the number is now actually around negative 12%, 12.5%. So it's the worst returns for bonds on record. But remember, the year's not over. So it could be that the back half, again, if we're right with GDP slowing and inflation coming off the boil, that bonds become a little more attractive. And maybe by the end of the year, bonds have a return of maybe -6 or something like that. Or we'll see. Like I just think it's probably a good time to start considering adding bonds to the portfolio. Next slide. This is again getting back to I guess earnings for companies with growth coming down and wage inflation going up and the input costs going up. Margins are likely to come off and go down, and the workers will tend to get a bigger piece of the pie. Over the last few years, or I guess at least the last decade or so, workers have not been getting their fair share. And I think in this environment with inflation and a shortage of workers, the workers will get more of the profits. And so margins are likely to come down and put pressure on equities. Next slide. We're already seeing it, that analyst revisions are coming off. And if you X out energy and financials, they're coming off dramatically. So I think the equities are facing a struggle of earnings coming off in an environment where rates have gone up, so that their cash flows are going to be less and also worth less in the current period. So I think that's the main reason why you're seeing the NASDAQ do as terrible as it's been doing in the first quarter and April and today. Next slide. So this is something put out by Goldman Sachs. Just when you have financial conditions tightening, that's what the FCI stands for, Financial Condition Index, tighten. These are certain characteristics that you should look for in stocks, or the factors: a strong balance sheet, low volatility, momentum leaders, a high ROE, and high growth stability, not necessarily just high growth, which doesn't tend to outperform, as indicated in the first one, or the third from the bottom. Next slide. So we had the inversion in the forward curve, and typically that's a forecasting of a market decline. In 2000 and 2007, there was a lot of lead time, 3 to 6 months, 18 to 24 months. And then in 2018, there was only about 3 months. And I think there's been less than 3 months this time. So the markets are, as you know, more computerized, and things move a lot quicker. We're already getting the markets coming off. And on the S&P and NASDAQ and the Russell, there's probably further to go. And even the TSX, it looks like it's starting to join the party. Next slide. So in looking at the US dollar, typically if you looked at since 1971, the US dollar has been in decline. But you go through periods where the US dollar gains strength or acts like a safe haven. And in those cases, usually something tends to break, because it could be something in the emerging markets. And lately, Sri Lanka, and Pakistan have been under pressure with their government funding and looking for IMF bailouts. So it does cause things to go awry globally when the US dollar gains so much strength. But for the US purposes, they probably want it because they want to quell their inflation. And so anything that they import is going to be less. And then again, speaking to other countries, all commodities are priced in US dollars. It's making their inflation or costs that much higher. I think the PPI or the PPI in Europe was over 37% for the month of April. So it is causing issues. And as you know, the euro's gone down from around 120, I guess a year ago, to around 105 today. But again, they haven't done much on the way of raising rates to catch up. So just imagine if they start raising rates, I think a recession is like a foregone conclusion in Europe. Next slide. And on gold, how does gold do when the US dollar is strong, and how does gold do when rate hikes? Well, if you went back to the 2015 to 2018 cycle, gold did okay. It did go up. So I think it will act as the second best currency, because in terms of euros and yen, gold is actually going up in value. Next slide. So how do you handle a quad 4 or all this doom and gloom? Looking back at what we did in December of 2018 and in March of 2020, our bonds were around 46% and our cash was 13%. So about 60% in cash and bonds in 2018 and almost 70% in March of 2020. One of the keys is really having a lot in US dollars, because again, they act as a safe haven and can go up dramatically. And just reducing your equity exposure. So I think at one point in March of 2020, we were about 18% equities. And I think in December of that 2018, we were probably around 25%. But that was just where we were at a point in time. So what have we been doing this year? So we started the year optimistic. We thought we had about 2 weeks into mid-January where the market would do okay, since it typically does. And small caps tend to do okay for the first 2 weeks of the year. But right away, the second day of the year, the market was under pressure. So we started the year at around 70% equity, 16 bonds, 11 cash. And by the end of early February, we reduced our equity to 56% and started bringing up our bonds, and our cash stayed relatively the same. By the end of March, we were already down to 40% equity and starting to raise our bonds up more dramatically, and our cash. So today, as we speak, our equity exposure is about 29%. Our bonds is around 34 and a half. Our cash is knocking on 30, like either side of 30, and commodities is around 6%. It's been difficult this year because normally in a quad 4 or a correction, the US dollar works. So we're about 38% US dollars. US dollar works and bonds work. And as we just went through, bonds have really been the big disappointment and have been no help. So nowhere to hide. Commodities have helped out a little bit with our golds and equities. It's been touch and go, really, unless you've been heavily overweighted energy. It's been a tough go in equities as well. So in conclusion, we think the 2022 will be a volatile year and is going to be difficult to navigate. But we do think we have a process in place that can get us through it. Growth will be more challenged. As we say, we think growth is going to continue to decelerate. And that's one of the reasons is the Fed is raising interest rates and making it more challenging for the consumer. Inflation, we think, will start to come in, but it's not going to come down from 8% to 2 or 0 or disinflate. We're still going to have high rate of inflation, probably of around 4 or 5% by the end of the year. So the consumer is still going to be struggling with less money in his wallet. As far as growth, the best quarter was probably behind us. And I know it was a negative quarter in the US, but on a year-over-year basis, it only gets worse as we go through 2022. And the Fed is determined to tighten financial conditions. So I think what people may be assuming, and I think they shouldn't, is that there's a Fed put this time. I think it's going to be difficult for them to get inflation down, or it's going to be more drawn out. Our forecasts don't even really take into consideration the Fed hikes. It's just forecasts based on what we know today. So maybe inflation does come off quicker, but for the most part, we think it stays sticky in the 4 to 5% range. So for 2022, we think caution is warranted. But again, I think we have a process where we can trade the market, and using our understanding of the VIX and our other tools, we can look for opportunities to go long and short. And hopefully by the end of the year, we can get ourselves back to break even or better. Next slide. Yeah, so this is a quote by Charles Darwin that we always have in. It is not the strongest of the species that survives, nor the most intelligent that survives. It is the one that is the most adaptable to change. And that's what our process is all about, is being able to change. And I think it's apparent in how we started the year, 70% equities, and here today we're 29%. So on that, I can take questions.
Terrific. Thanks so much, Ted. We do have a group of questions here that I'd like to get through. The first one is the new global growth and income going to be managed using the same risk management research and process as the growth and income fund?
The short answer is yes, but it will be on different markets. But we have access to inflation and growth on, I think it's 29 different markets.
Terrific. The next one is, given possibility of recession, will the fund raise more cash down the road? Is there an approximate target percentage, or will the fund neutralize market risk by shorting more?
Yeah, good question. Well, I do believe we will just, if cash is the appropriate move, then that's what we will do. Our limitation on shorting is 20%. Currently, we're short about 12%. So we have some limitations, and by having the cash, it helps reduce the volatility.
All right. The next one, do you consider this fund to be very actively traded in each quad, or more so in certain quads?
Well, in each quad, there's, as you can see, there's different sectors that are expected to perform better. So we are always changing. So at the beginning of the year, we were 11% in technology, and today we're one and change. And that's because in a quad 4, technology does not do well. Whereas when we were coming out of a quad 2, or we expected that to still act well, that's one of the better sectors to be in.
Okay, next one. Investor sentiment is at lows not seen much in the last 30 years. This is usually a buy signal. In your opinion, is there a delay in a bottom happening this time?
I think if you take a look at 2008, it stayed low. Like the amount of bulls stayed at a low range because the market was experiencing a lot of volatility. So I think that is due to the volatility in the market that we're registering that. Historically, it has been, but I think it does get back to the episodic move or the trending move. And I think we're in this trending period. So yeah, is it for another 3 weeks or 3 months? I can't answer that yet.
Okay. Next one's about recession. This one might be a little tougher to answer, but if we head to a recession globally in the US or Canada, do you see it being mild or deep?
Again, I would say it depends on the response by the Fed. But so what happened in the 70s, Arthur Burns was in charge of the Fed, is you got the shock, the oil shock in 1973, and they raised rates. You got a recession, but inflation didn't come off enough. So you were starting with a high inflation, and then they started lowering rates. And then before you know it, inflation was out of control by the end of the decade. And then you had to get Volcker in to really rein it in. So I think they really want to try to avoid that's why I think you shouldn't be counting on the Fed put to come in and lower rates again to save the stock market. I think they're going to take rates up, and maybe that gets to 2%. I don't know that it even gets that high, but they'll probably pause it there. Whatever level the market gets to, they'll probably take a pause and hope that the market finds its footing. So again, the answer to that question is difficult in the sense of where does inflation go, and a big wild card is any kind of resolution in Ukraine and Russia, which I would say is not in the cards or not on the table in the foreseeable future.
Okay, next one here is very easy for me to ask. The answer may not be quite as easy. Your outlook for Canadian banks.
Yeah, so we have, I think it's about 1.4% in Canadian banks. Well, they're going to suffer, I think, because I think you'll see a number of bad loans. And if it turns out that we fall into a recession, the bank sort of financials tend to do poorly. Quad 4 is not a very good quad for financials. So we're an underweight. And I would say that's a big call on our part, where financials make up about 33% or more in the TSX. And here we just sit at 1.5%.
Interesting. Here's one more that we just received. I've seen so many commentaries or broadcasts that inflation could go on for significant length of time. I am of the opinion that we could be in for the mother of bull market runs in gold and gold, silver mining equities. Valuations in this sector are very depressed. Your thoughts, please. And I know you touched a little bit on gold, but was there anything that you wanted to add as far as the gold and silver mining stocks?
So we own about 6% in gold itself, the GLD, and around 4.5% in the equities. Unfortunately, equities act like equities. So the stock market is getting faced with this volatility attack. They will come down, but I hate saying that we're bullish gold, but we're optimistic that gold can do well in this environment. And again, it gets back to not like in other currencies, it's doing much better. And even in the US dollar, it's doing reasonably as an asset class.
Another one just about housing. Is the lack of inventory in housing in the US similar to that in Canada? This has always been the reason why Canadian housing has generally held up, and they're asking for your thoughts.
Yeah, so I would say it's similar, but it does come down to affordability. If the house is listed at 500,000, you can only afford 400, then there's no transaction. And that's usually the first step. And like I said, in April, the transactions were down 25% in Toronto and Vancouver. So the first step is that there isn't a meeting of the minds, the seller and the buyer, so transactions decline. But ultimately, if the seller's a real seller, he'll have to come down to the buyer's price, unless, again, real wage inflation starts to pick up.
Another one, again, that's easy for me to ask, but the answer might be a little bit more challenging, is what is your outlook for the price of oil in the upcoming months?
Yeah, that's a challenging one. I'm sure most people have heard on TV or read that there's a shortage, and also with the embargo that they're planning to take place by the end of the year. Europe and Russia are, it's not for sure, but that's what they're talking about. So that'll be, I think, about 6 or 7 million barrels of oil off the market. So it'll tighten things up. Again, I would say oil prices are probably going to stay elevated, but that doesn't mean it's going to contribute to inflation, because it's already contributed from last year. Like last year, it was cheap and now it's expensive. But if it stays at 100 or 105, it's not increasing relative. So it's not contributing to inflation. But it's likely, I would say it's likely that oil prices stay elevated along with natural gas.
Okay, we've got two more. I think maybe we can try to squeeze them both in before the top of the hour. The first one goes back, I think, probably to a previous presentation that the advisor may have seen, but it said, Ted, your previous position on rates was one and done. What do you see going forward? Looks like 3 by 50 or more with a question mark. So I guess they're asking your thoughts on how many more rate increases are we going to see?
Yeah, I guess the Fed doesn't really care what I think, but each hike is going to have more and more of an impact. And I think, again, maybe we're wrong. We just have to see that. But I think Powell and co are under the impression that the US economy is extremely strong based on job availability and unemployment. But as we know, small and medium-sized businesses create the most jobs. And in the report this morning, it was small and medium-sized enterprises that shed 100,000 jobs on a week-over-week basis. So it could be the beginning of something that they're not really prepared for. So I think the raising of rates, it more goes back to that should have happened in a quad 2 environment. It's happening in a quad 4. They missed their opportunity last year. And maybe we wouldn't have had such a run in the equity market last year if they had started raising rates then. It would be more of a smoother ride. Now we have this, they're giving us a choppy ride.
Okay. So that takes us to the top of the hour. There was another question that was in the queue, but it seems to have dropped off. So maybe I'll ask Colin to see if he can find that question and we can get back directly to the advisor with the answer. If I recall, it was something along similar lines to the question that you just answered. So I think maybe that would have answered the question, but we'll do our best to try to find that question and get back directly to the advisor. So we are at the top of the hour. That will conclude the presentation for today. I would like to add that our next webinar will be on May the 19th, where we will be featuring Jim McGovern and Chung Kim, and they will be talking specifically about a couple of our liquid alternative strategies. And I believe that will be a very timely discussion as well, based on what we're seeing specifically today in the market and what we're likely to see as far as volatility continuing going forward in this year. So thank you very much, Ted, for helping us out with the presentation today. We appreciate that very much. I know you probably want to get back to your screen and see what's gone on since we started an hour ago. And of course, thank you to all of the folks at Arrow Capital who made this happen, and the advisors and associates who tuned into the call today. We appreciate you always coming on to these calls, and we certainly appreciate you picking up the phone and meeting us when we are out and about in your offices. So thanks again, and we look forward to seeing all of you again soon. Bye for now.